Business cycle. The economy experiences cyclical fluctuations known as the business cycle, which create a wave-like pattern when indicators such as employment, volume, price level, output, and income are graphed over time. Various factors, including changes in credit creation, capital goods, consumer goods ratios, maladjustments, and human psychology, cause these fluctuations. Weather cycles also impact agricultural production and the prices of essential goods the working class consumes. Preventative and corrective measures can be taken to control these fluctuations, including monetary and fiscal policies and automatic stabilizers. Various methods, such as the trend projection method, the least square method, time series data, the moving average method, and exponential smoothing, are used to forecast business cycles. Phases of business cycle. The business cycle has four phases. The first being the phase of prosperity or boom. During this phase, the economy overgrows and leads to full employment. The second stage is the phase of recession or contraction, where pessimism replaces optimism and businesses struggle to sell their products, leading to the withdrawal of investments. The third stage is the phase of depression, which is characterized by low prices, low demand, overproduction, idle production capacity, and general unemployment. The fourth stage is the phase of revival or recovery, where business activities improve, industrial production picks up, and new investments are made. The government announces measures for economic development, creating an atmosphere of saving and investment, increasing demand for goods and services. The gross national product and national income increase while entrepreneurs focus on product innovation and development. Tools to control inflation. A persistent increase in the general price level is known as inflation, which occurs when the money income expands with the output of productive agents for whom it is the payment. This leads to a rise in prices due to excessive money supply and lower production of exchangeable goods. Inflation happens when aggregate supply fails to match the increase in aggregate demand. To control inflation, the supply of goods and services should be increased, while money incomes are reduced to regulate the aggregate demand. There are three categories of tools that can aid in controlling inflation: monetary measures, fiscal measures, and other measures. Tools to control inflation, monetary policy. Economic standards aim to decrease money incomes. One of the critical measures is monetary policy, where the country's central bank adopts various methods to control the quantity and quality of credit. This includes raising bank rates, selling securities in the open market, raising the reserve ratio, and adopting selective credit control measures such as raising margin requirements and regulating consumer credit. Monetary policy may need to be more effective in controlling inflation due to cost push factors. Monetary policy is only helpful in preventing inflation due to demand pull factors. One measure that can be taken is to demonetize currency of higher denominations, usually done when there is a surplus of black money in the country. The most extreme monetary measure is the issue of new currency in place of the old cash, which is highly effective when hyperinflation exists in the country. Tools to control inflation, fiscal measures. Fiscal measures are highly effective in controlling government expenditure, personal consumption expenditure, and private and public investment. The government should reduce unnecessary spending on non-development activities to curb inflation. Individual, corporate, and commodity tax rates should be raised to cut personal consumption expenditure, even if new taxes should be levied. However, the rate of taxes should not be so high as to discourage saving, investment, and production. Tools to control inflation, increasing production of essential goods. Increasing the production of essential consumer goods is one of the foremost pressures to control inflation. This can be done by importing raw materials of such products on a preferential basis if needed, and by increasing productivity by using the latest technology, providing financial help, providing subsidies, etc. Tools to control inflation, national wage and income policy. Another important measure is to adopt a national wage and income policy. Under hyperinflation, there is a wage price spiral. The government should freeze wages, income, and profits to control this. However, such a drastic measure can only be adopted briefly, as it will likely antagonize workers and industrialists. Tools to control inflation, price controls, and rationing. Price control and rationing are other measures of direct control to check inflation. Price control means fixing an upper limit for the prices of essential consumer goods. Rationing aims at distributing the consumption of scarce basic consumer goods such as wheat, rice, sugar, etc. It is meant to stabilize the prices of necessities and assure distributive justice. However, it is inconvenient for consumers because it leads to corruption and black marketing. Tools to control inflation, other measures. Finally, to control inflation, it is essential to adopt other measures such as increasing savings on the part of people and adopting an anti-inflationary budgetary policy. The government should give up deficit financing and instead have surplus budgets. It means collecting more revenue and spending less. At the same time, the government should adopt repayment of public debt and postpone it to some future date until inflationary pressures are controlled within the economy. Instead, the government should borrow more to reduce the money supply to the public.